Are we witnessing the birth of a transformative technology, or the inflation of a massive financial bubble? Here's the puzzle. While tech stocks soar to unprecedented heights on AI enthusiasm, another corner of the financial markets is telling a surprisingly cautious story. Today, we're diving into one of the most fascinating contradictions in modern finance, what analysts are calling the AI investment paradox, where different parts of the market seem to be pricing in completely different futures for the same technology. Let's start with the numbers everyone's watching. Global AI spending is projected to hit $375 billion in 2025. That's massive, and it's creating a heated debate on Wall Street. Recent surveys show that over half of fund managers now believe AI stocks are in bubble territory. Yet major investment banks like Goldman Sachs disagree, calling this early-stage exuberance rather than a full-blown bubble, pointing to strong earnings from leading tech firms. So who's right? Financial analysts look at several key indicators to assess bubble risk, and right now, we're seeing some concerning patterns. First, valuations are stretched. Major stock indices show significantly elevated price-to-earnings ratios compared to historical averages, though defenders argue this reflects AI's genuine potential for productivity gains. Second, the "this time is different" narrative is everywhere. Every major bubble in history, from railroads to the internet boom, was fueled by belief in a paradigm-shifting technology. Sound familiar? Consider the infrastructure boom. Companies with minimal revenue are receiving multi-billion-dollar valuations purely on AI-related promises. One analysis describes this as firms pricing to perfection, meaning there's little room for disappointment. Third, investment patterns are becoming interconnected. Major tech companies are engaging in complex circular arrangements. Recent reporting documents multi-billion-dollar cross-contracts where AI companies operate within an increasingly complex and interconnected web of transactions. Firms are simultaneously customers, investors, and suppliers to each other. These intertwined deals can inflate valuations detached from fundamental cash flows. Fourth, leverage is increasing. Margin debt has surged to record levels, and risky financial products are exploding in popularity among retail investors who may not fully understand the risks they're taking on. But here's the critical nuance. Unlike the dot-com era, with hundreds of startups that collapsed to zero, today's AI boom centers on established technology leaders with deep cash reserves and real revenues. This structural difference matters. Now here's where our story gets really interesting, and where the paradox emerges. While equity markets celebrate AI's potential, bond markets are telling a different story. And this matters because these two markets are responding to the same information about the same technology. Let me explain the theory first. When investors genuinely expect higher future incomes from productivity growth, they typically save less today. If you're confident you'll be wealthy in 30 years, you're less motivated to save aggressively now. This reduced savings should push interest rates on long-term bonds higher. But that's not what happened. Researchers at a major university analyzed treasury bond yields around significant AI model releases. The results were striking. Long-term bond yields didn't rise. They fell, typically by around 10 basis points, and these declines persisted for weeks. Under standard economic theory, falling yields suggest investors are actually lowering their expectations for future consumption growth, the opposite of what you'd expect if markets believed AI would drive widespread prosperity. Now, before we jump to conclusions, we need to acknowledge complexity here. bond yields don't respond solely to AI growth expectations. They're influenced by inflation forecasts, fiscal policy, global capital flows, and broader risk sentiment. In fact, yield movements showed cyclical patterns throughout the year, initially rising before later decoupling from traditional drivers. So we can't attribute every basis point movement purely to AI sentiment. But the consistent pattern around AI announcements is still noteworthy. And here's the kicker. Forecasting platforms show technical experts became more optimistic about AI progress after these same announcements. So the bond market wasn't reacting to disappointing technology. So we have a genuine puzzle. Why would stock and bond markets react so differently to the same AI developments? The answer may lie in recognizing that these markets represent different investor constituencies with different priorities. Equity markets respond to concentrated profitability and capital spending momentum. Tech stocks rally because specific companies are capturing enormous revenue from AI infrastructure. The so-called Magnificent Seven. Tech leaders are genuinely profitable and investing heavily. Bond markets, however, reflect broader macroeconomic concerns, aggregate growth, employment, consumption across the entire economy. This leads to several possible explanations for the paradox. Scenario 1. The productivity lag. Historically, transformative technologies take years, even decades, to generate economy-wide productivity gains. Bond markets may simply be pricing in this patience, not pessimism. Subdued yields might reflect realistic timelines rather than skepticism about AI's potential. Scenario 2. Concentrated benefits, distributed costs. Perhaps AI's benefits will flow primarily to tech companies and their shareholders, while costs, potential job displacement, wage pressure, increased inequality, spread across the broader population. In this scenario, certain sectors prosper enormously, while aggregate consumption growth remains modest. Scenario 3. The capital allocation question. Some analysts worry about potential capital misallocation, that massive AI infrastructure spending may not generate proportional returns. One analysis describes this as an increasingly evident mismatch between investment and near-term revenue potential. Scenario 4. The Fed conundrum. Large-scale AI capital expenditures appear insensitive to interest rate policy. This creates uncertainty. If these investments prove less productive than hoped, or if AI capabilities become commoditized rather than proprietary, long-term growth projections weaken. So where does this leave us? First, let's acknowledge what we're not seeing. We're not in late 1990s dot-com mania territory yet. Current market sentiment suggests we're in an earlier stage. Think 1996 or 1997, not 1999. The most extreme speculative behaviors haven't fully materialized. Second, structural factors provide some cushion. The concentration in established tech giants with proven business models limits systemic risk compared to previous bubbles. A catastrophic crash seems less likely than a gradual valuation adjustment. Third, the cross-asset signal matters. The coexistence of equity exuberance and bond caution is precisely what makes 2025's financial landscape distinctive. This isn't necessarily a paradox in the sense of logical contradiction. It may simply reflect different investors pricing different aspects of the same complex reality. For professional investors, the key question is whether institutional money will abandon diversification and go all in on AI. Right now, institutions hold positions but aren't aggressively adding. If that changes, if they pull back from bonds, gold, and other sectors to concentrate on AI, that's when the bubble inflates further. For policymakers, Understanding whether market caution reflects concerns about disruption, wealth distribution, or productivity timelines is crucial for designing appropriate responses. So what's the final takeaway? The AI investment paradox is real, but it's more nuanced than simple contradiction. Financial markets are sophisticated information processing systems, and right now they're telling us something important. Yes, AI capabilities are impressive and improving rapidly. Yes, specific companies are positioned to capture enormous value. But the path from technological breakthrough to broad-based economic transformation is neither automatic nor guaranteed. It may take longer, distribute benefits more narrowly, or encounter more friction than optimistic narratives suggest. The gap between stock market celebration and bond market caution doesn't necessarily mean someone is wrong. It may mean both are right, pricing different dimensions of a genuinely uncertain future. Perhaps the wisest conclusion is this: we're not witnessing simple euphoria or simple skepticism. We're watching markets grapple with genuine uncertainty about how transformative AI will truly be, and for whom. As one analysis put it, the coexistence of exuberance and caution is a defining feature of our current moment. The AI revolution is real. The economic transformation everyone expects, that story is still being written, and markets are telling us to watch carefully. Thank you for watching.